Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, March the 4th, 2026. Okay, let's see what's going on. Obviously, what's dominating the headlines is the Iranian-Israeli-US war. What we saw yesterday, I just want to focus on the volatility space for a moment, because what we saw yesterday was a pretty substantial increase in cross-asset volatility. So not only the volatility for, let's say, for gold or obviously for oil and energy, nat gas, things like that, but across the space, we saw quite a lot of volatility in FX. We saw it in emerging market FX. We also saw it in sort of a non-US stock markets. And obviously, last night we saw a huge sell-off in the Kospi and in Asia in general. But so let's just have a quick look at all this and see what's going on. And why do we want to talk about volatility? Just because, as I keep on trying to say, for institutions, volatility is a key input into their positions and their position sizing. Automatically, mechanically, once volatility rises, that means that the value at risk, the VAR, the potential for losses goes up. And therefore, as I say, automatically, mechanically, positions are deleveraged, basically are reduced. That means everything. And something like the US dollar, where, a lot of people, for example, maybe are short, automatically those positions have to be unwound. And if you have any extreme kind of positioning, you have an unwind mechanically, which, for example, might cause a short squeeze in the US dollar, apart from the safe haven, sort of the natural bid. Okay, so as you see here, this was snapshotted yesterday afternoon at the close, more or less, after 4 p.m. And what you can see here is that the actual VIX, the spot VIX, you see here, that's the straight line here, very, very elevated. At about 23 and a half. And as you can see above all of the futures curves. So just going back a little bit, you can see how this futures curve for the VIX products, for the VIX futures has changed. So if we go to the green one, which is essentially the end of February, so not that long ago, like a week ago, and then, on the 27th of February, and then you have the orange one is the second, and then yesterday is the third. So what you can see is that the spot VIX is above all of that. So it represents that an elevated value. And also you can see that as sort of a tension and sort of nervousness and volatility is rising, you see the front of the curves is going up. And what that means, that's signaling that the danger, so to speak, or the volatility is immediate rather than traditionally sort of being out into the future somehow. So let's keep an eye on the shape of the VIX curve, and just generally sort of volatility is high. Okay, so let's look at a few different charts. Put this all into perspective. So again, just talking about volatility, we just looked at the VIX, and as you can see, it has come down a little bit overnight, but still in that 22, 23 range, 24 range. And that's signaling, at a minimum, 1.5% move is potentially implied move, I mean. And we saw yesterday, the stock sold off, then they had a nice comeback. So volatilities are both ways. We can also see here that in the bond, the move index, which is volatility of bonds, you can see that that also is very, very elevated, and that is not great for equities in general. Obviously, in oil, volatility is at extreme levels, no surprises there. But also seeing in the precious metals, you see gold volatility is spiking upwards. So overall, vol also I don't have it here, but also for FX, volatility is up. Just gonna grab some tea. I'm a little ill this morning, but that's okay. Okay, so just looking at overall, let's just look at what's going on. So we see here, if we look at the equities, you can clearly see that the moving averages are rolling over. This is the ES. And if we look at something just, I mean, is this some kind of just sort of rounding top? So if we just put it on this little gadget here, this technical indicator, like a rounding top, it does seem, if I could move it rather than just having this little crescent there. Look at that. So you see here, what we definitely seem to be getting is a rounding top. And you see this is just trading heavy. There's a lot of gravity in this market. So now just from a technical perspective, we did bounce yesterday, but this is still very weak price action. So just in terms of what we may need to see, just a couple of, sort of key indicators. Let's have a look here. And you see that even in the fib, we're getting quite weak here. So we're sort of really going below the 61.8% and the 65%. And bouncing off it. But it's looking weak. So, we're seeing that any rallies here are not being they're not being sustained. If we look over at the NASDAQ, you can also see here that that's much weak. You see the 20 days moved over the 100-day EMA. We also see that we're now testing the 200 days. So I would say just in the short term, you see these levels here around about 24,400, 24,500 are obviously key. We're also testing the 100 days. So the 100-day sorry, the 200-day EMA is the line in the sand, and that's the one which I'll be keeping an eye out for Nasdaq here. Russell, looking at that again, like everything else, has bounced a little bit overnight, but again, pretty weak, not as weak as, let's say, sort of the Nasdaq, but overall sort of weak. So the equities, and what do markets really need to see? What are the keys? So the key here is obviously the price of oil, but the price of oil is really going to be a function of two things. Is the famous sort of Strait of Hormuz, is that going to be open? Is sort of energy sort of shipments, are they going to be able to sail through? Now, Trump yesterday said that he was putting the federal institutions, the state of the US, the federal institutions would back sort of insurance for shipping companies. So that was a positive. He also said that there would be a possibility of naval convoys, of actually sort of accompanying sort of tankers and whatnot through the Straits of Hormuz. But the problem there, we actually haven't seen that on the ground, and that could actually raise the stakes, because that means that if we suddenly have US warships which are not, 200 kilometers away, but literally, 3 or 4 or 5 or 6 kilometers from the shore, where the Iranians have a lot of ballistic missiles and drones. I mean, could this actually cause an escalation? So the point is that although Trump's comments yesterday calmed the market, the oil market, we can see if we just actually we'll go to the oil market. Just let's have a quick look as we're chatting here. You look at the oil market here, it actually spiked higher. So it went down, but overnight the market is essentially still nervous and not convinced. And we see the gap up on Sunday night here. Which went up here. I mean, it came down, but you can see here that the market is still trading at a very, very elevated level. The market is still saying, hey, the Strait of Hormuz is effectively not open, despite what the US president is saying. There's the potential for escalation. And really, what could be a massive escalation would be if serious infrastructure is sort of destroyed. At this point, the Iranians are actually with drones sort of attacking. We've seen attacks in the UAE at a key sort of shipping port. We're also seeing some attacks on Saudi facilities. We saw Qatar Energy for all of the nat gas. So the point is that in the Gulf and Saudi Arabia, oil processing and nat gas processing facilities are being attacked. They just haven't been literally destroyed yet, but we're just one ballistic missile away from destroying, 2 or 3 sort of energy infrastructure points, and suddenly the world is going to have some severe, even more severe, sort of energy outages. Now, we're not there yet, and it is possible that the US intervenes more dramatically in the Strait of Hormuz. So we're going to have to watch the headlines today. But you can see here that the oil market is not giving the all clear. If it was the all clear, it would be down somewhere, the mid 60s or the late 60s. At this point, we're still in the mid 70s. Now, there's going to be sort of headlines going up and down during the day, but the market is worried about that. By the way, I just want a quick look at the calendar spreads here, and I've got a couple up here. So I've got April, which is the front contract, to June, so the 3-month calendar spread here, and you can see that that's still pretty elevated and is in a sort of a backwardated state. So the front end is going up a lot. Also, if we look at April to December, you can see that that's almost, I mean, that's almost up to a premium of over $10 now, which is very high from a sort of a historical point of view. So you can see here that the market is definitely signaling physical tightness for immediate deliveries in the front end. So we see that sort of a curve here in backwardation. And the other thing which I was reading about is kind of interesting is that let's keep in mind that a lot of these countries in the Gulf and Saudi Arabia, in terms of water, their water supplies, obviously it's mainly a desert sort of landscape, very hot, very dry. The point is that these massive desalination plants, which sort of essentially, take the salt out of water and are used, there's just a few of these massive desalination plants. And if the Iranians decide to get sort of nasty and destroy some of these, this will create massive problems for the civil population. So at this point, we're not talking oil, we're not talking energy, we're not talking military infrastructure, we're talking people not having drinking water. Now, that would be a massive escalation. Point being that things are not over, and Trump and the US administration clearly doesn't seem to have a succession plan. There's talk today that in Iran, the new supreme leader will be nominated or actually elected, probably Khomeini's son, who apparently is still alive. Good luck to him, I would say. But the point here is that there's still a lot of potential for for continuing escalation. So we can't signal the all clear just yet. Okay, And for example, just looking at oil, yesterday we had the news from Iraq that they're running out of storage. So the problem is that if you continue to produce oil, normally you put it, onto tankers and it's shipped out to, in this case, mainly to Asia. But what we're seeing is that with the cessation of sort of tanker shipments, the countries like Iraq basically saying, "Hey guys, we're running out of storage on land." The huge sort of tanks. And Iraq yesterday, they shuttered, was starting to shutter. I think there was one like up to up to sort of 1 million barrels per day of they're just basically turning off the taps and saying, "Hey, until further notice, we can't produce anymore because we have nowhere to put that." And the more and more that happens, countries will stop producing, and that's going to keep the oil market under pressure. Okay, so what happens if we have an oil market under pressure? So first of all, as I said, this is having some knock-on effects, and I'll get back to equities in a second. But the knock-on effects, so we see here that obviously oil prices elevated. We see over in Europe the global benchmark for nat gas. It's come down somewhat, which is good news. Come down to about 56 euros, actually more like under 50 euros. But you can still see it's very, very elevated compared to where it was in the mid-20s or up to mid-20s to 30s. So nat gas are still very elevated. We still have no nat gas shipments coming out of Qatar. So the point is that energy is getting more and more expensive. And what does that cause? That causes inflation worries. So let's now look and see how some of the markets are repricing some of these inflation worries. And a way to do that is just to go to the SOFR, which is we'll get the implied yields here. So if we just look here, let's say for let's say the June 26 contract, this is the implied yield. So what we've seen here is that pricing for the Fed to cut is going to be more and more difficult. Even Kevin Walsh, for sure, does he want to cut? Will he cut? Probably. But as inflation expectations are going up, as energy prices are going up, the possibilities of easy cuts and easing financial conditions are diminishing. And you see here that, for example, this is the implied yield for the June contract. You can see here it's gone up from 3.44% up to got up to almost almost 3.6. So you're talking maybe 10, 12 basis points. Then if we go just out through some of the contracts, even more, September, you see this spiked. I mean, it was at 3.2, it spiked to 3.45. That's 25 basis points, which is one cut removed in terms of the pricing. We see then for December, the implied yields also are moving up 10, 15, 20 basis points. So the point is the market is saying, hey, this could be a nasty inflationary shock. Therefore, the Fed might be cutting less. So what does that do? We also see that over in Europe. Before we get on to consequence, Euribor, which is kind of like the SOFR, so the 3-month, bonds of their futures, and you can see here. We'll go here in for September of 26, you can see that also spiked. So the ECB, which has been saying for a long time, hey, we're in a good place. We don't need to hike rates, or we don't need to cut rates. But you can see here that was just over about 2% and got up to almost 2.17%. So that's about 15 basis points of sort of hawkishness, which the market priced in. Now, as you can all see, overnight, generally markets have calmed down. So, some of these pricings have come down. Equities have rallied a little bit. But we get the point here. You see here also looking out for September and even December of 2026. This is massive. So we went from just under 2% to 2.24. That's another full, that's 25 basis points. So a hike was priced in temporarily into the European sort of bond space. So what is that doing? So we're getting sort of more inflation fears. We're getting yields going up. And what that means is that that's also supporting the US dollar. So if we look at some of the knock-on effects here, if we look at some of the FX markets, we can see the US dollar, which had been very strong and broken out of this fib level, moving averages pushing up through the 100, through the 200-day, and it spiked yesterday up to 99. I don't think it's going to get up quite to 100. Now, it's calmed down a little bit overnight. But basically what's happened is have a safe haven bid for the US dollar, and you've got the yields going up, especially at the front end of the curve for the US. So those yields going up based on inflation fears because of increased energy is giving a bid, sort of flows going into the US dollar. Now, what's that doing? That's obviously pushed down all the other currencies. So you see here, all of the importers of energy especially have been hit. So for example, Europe, you see the euro's under pressure, bouncing off the 200-day here. The Swiss franc has had weakened a little bit, but that a lot of that was also because the Swiss franc was so strong that we actually have been seeing some intervention talk by the Swiss National Bank. Both the sort of the governor and the deputy governor are saying, "Hey, we may have to intervene if the Swiss franc gets too strong." So that's a separate case. But overall, the US dollar has been very strong. You see against the Japanese yen, it's ripped higher again overnight. We've seen a little bit of calming. We've seen the Aussie also doing pretty well against everything except for the US dollar. And again, outperforming because the economy is doing well. We had strong GDP numbers last night for Australia and you know, in a pretty strong sort of nat gas commodity exporting vibe. Overall, the US dollar has been strong. But where we've also seen quite a lot of action has been in the emerging markets. And one of the interesting things is that if you get sort of your currency selling off, so let's say, for example, you see the unwind of the carry trade. So you see here Mexico, Japanese yen, just the panic sets in and people start to sort of offload that. And then you also see the US dollar versus the peso. Now, the peso in Mexico has been incredibly strong against the US dollar. You can see the chart here for a long time. But you can see the unwind over the last 48 hours here, the US dollar ripping higher. You can also see that against the South African rand. You can see it against the Brazilian real, and you can see it against the Korean won. So against all of these emerging market currencies, when the sudden depreciation, often the local central bank from these emerging markets they say, hey, we need to support our currency, so maybe we need to basically sort of sell some US dollar. We need to buy back our own currency. So in order to do that, they will basically sell some of their treasuries. So they're going to raise US dollars. How do you raise US dollars to buy back the local currency, to strengthen the local currency? First of all, they need to sell US treasuries and get a bunch of US dollars. So that's also one of the reasons yesterday where we started seeing the correlations going to one. And what do I mean by that? We start seeing a situation where, you know, yesterday, for example, we saw equities falling, but not only equities, we also saw, for example, you start even to see sort of gold falling as people sort of scramble for sort of margin and just for liquidity. So also central banks may be selling some of their gold. So you see gold falling, you see silver falling, had a big fall yesterday. And you also, of course, not acting as a safe haven, you're going to see something like the 10-year, the ZB falling. And well, there's the ZB there and the ZN. So you put it all together, kind of a toxic mix of increased inflation expectations because of the energy. We see energy prices going up. Then there's starting to have knock-on effects. And of course, as correlations go higher and volatility go higher, vol targeting fund and all institutions, as their VAR, value at risk, goes higher, the potential for loss, they start to scale back and deleverage. And you get this whole kind of cascading cross-market sort of volatility. And we're seeing a bit of a fallout in some of this sort of cross-market because we're seeing here some of the other markets. You just see global equity, especially in Asia, having a pretty nasty overnight. But also we saw Brazil, you know, been saying that that was relatively insulated because of the you know, the strong sort of position of as export of commodities. But my point being is that as correlations across assets start to go towards one and become more correlated, the chances of you know, sort of contamination increase, and then people start deleveraging. And they go, oh, let's get rid of some of the Brazilian stocks. Let's get rid of a bit of this. Let's sell a bit of gold. Let's, you know, let's sell a few sort of emerging market equities, etc., etc. So Brazil hit hard. We're also seeing over in China the A50 down. We're seeing the Shanghai 300 gapping lower. And the big one, of course, we also saw the Nikkei. Look at the Nikkei, which had been doing super well. And of course, the famous one is the Kospi down, I think, was it 12%? That came back from a holiday. Very nasty surprise. A lot of late longs, weak longs into the market, over leveraged and selling off. So the point is that all of this stuff starts to cascade. So the question is, what happens today? Well, what does happen today is that we do get a little bit of data. So I just want to draw your attention here. If we look at some of the data, I think what's going to be interesting, just keeping an eye on things. Now we have the beige book. So if you look this afternoon, I think we have the beige book at 2 p.m. Now, why is that interesting? The beige book gives sort of anecdotal evidence across all of the Fed districts in the US, essentially saying you know, well, that's sort of what's going on in the economy. And that's going to be interesting in terms of an inflation read, because the market really wants to know, are inflation expectations picking up? Is inflation itself picking up? Is this a problem for the Fed? Because remember, it's a global economy. If, you know, things get out of hand in the Middle East and the Gulf, Is the Fed going to be in a situation where it can cut aggressively? Remember that when Russia invaded Ukraine, interest rates were still, the Fed was able to sort of keep interest rates relatively low at that point. Interest rates were relatively low. So let's keep an eye on the beige book. But probably what's going to get the markets more attention, we have the ADP number for the week at 8:15. That's expected to be 50,000. So, are we going to continue to see a relatively strong US labor market? That's important. But probably the most important one today in terms of the data is the ISM services. In general, you just want to know what's going on. But I would say the prices component is very, very important. Remember, we had the ISM manufacturing a few days ago, and we had a reading of 70. So very, very, very elevated producer price input, inflation expectations going up on that, plus the whole energy situation. So the market today, I think, will be quite focused on that ISM services, the prices component. Previous was 66.6, the devil's number. Forecast is for about 66. If this comes in, at 70, 71, 72, the market will not appreciate that as that may be considered more evidence of increasing in inflation, and combined with the elevated energy prices will not be great. Okay, guys, so I might leave it there. Just want to have a quick look. You see the metals here, having just sort of trading within this range here. But what is interesting, BTC, as I was saying yesterday, forming a little bit of a base here and breaking out essentially. So you see here it's starting, you see the 20-day moving average starting to move up. So this is very, very positive price action, or let's say encouraging price action. But what I will say is the first test, I think it's a pretty critical test here for the BTC and in general for the crypto markets, because you can see just even from this most recent down impulse, let's say starting from the 28th of January, you can see the fib, the 38% fib level here, which also coincides with the level on the 8th of February. So that's at 72,170-ish. That's the key. The bulls need to break through there. If this fails there, and we sort of drift downwards. I mean, it's not over, but that would be the first bullish hurdle failed. So that for me is going to be a pretty important one to watch in the crypto space, but especially specifically in BTC, is that 72,100 level, which is the 38% fib there, because the bulls need to start cracking through this sort of resistance of some of these fib zones at a minimum. And I'd say that we can't really say it's anything other than a reactive bounce, really, until we get above 79,000. That to me would be indicative of a bullish change. At the moment, we have sort of a basing formation trying to form itself, and an attempt at a breakout, which for sure is positive and optimistic, but it's not over yet. Let's just continue to monitor that. Okay, guys, take care. Have a great day. As I say, obviously, we want to see what's going on in the Strait of Hormuz. If there's any sort of moves announced by the US administration to stabilize the oil market, we didn't get a strategic petroleum reserve release, but what we did get, as I say, was sort of guarantees of potentially convoys and also insurance guarantees. But they haven't materialized yet. They have not yet materialized. So the market wants to see evidence of that, and also wants to see evidence that things are de-escalating. And as far as I can see, the Iranians are they're not backing down, and I think the situation could get sticky, because just to finish on this note, there's talk that the Americans, the CIA, are actually starting to back some militias like the Kurds who are on the border with Iraq. That's considered a separatist movement. The Iranians are not going to like that. To be honest, the Turks are not going to like that either, because, at the end of the day, the Kurds want to establish Kurdistan, which is a bit antithetical to the nationalistic desires of Iraq, Iran, and Turkey. So the point is the Americans to throw a bunch of money at the Kurds and other sort of militias. I don't know that this is a recipe for stability. So the point is, an endangered regime in Tehran, a threatened regime in Tehran, could become a desperate regime in Tehran, and they could actually escalate into more attacks on energy infrastructure, desalination plants, and maybe American warships. If the American warships start, sort of escorting tankers through the Strait of Hormuz, I mean, what's going to happen if a ballistic missile hits a US aircraft carrier? That will get the market's attention. Anyway, we're not there yet, so let's keep on monitoring things. Have a great day, and let's keep an eye also on the VIX and volatility. That needs to come down to continue the equity bounce. Take care, guys. Have a great day. I'll be back tomorrow with the macro snapshot. Thank you.